everyone, and welcome to the Pear Tree Mining CFO series. Just a few housekeeping notes before we begin. This is a live recorded virtual event. So if you have any questions that you'd like to ask to the panelists or to our moderator, you can do so by clicking on the Q&A icon at the bottom of your screen. If the question is not answered live, we'll make sure that we get back to you post-event via email. We also wanted to let you know that this is a recorded event and it will be posted on the Pear Tree website post-event, so later this week. I'd now like to introduce the CEO of Pear Tree Securities, Lisa Davis.
Thanks so much, Laura. And I'm really pleased to see that we have over 200 people registered for this webinar today, which is even more timely, I think, than we imagined when we planned it, because there have been a number of very recent developments. Even a Supreme Court of Canada decision just released on Friday addressing a number of aspects of regulation for mining projects in Canada. So I'd like to go on now, and if you could, I'm not sure, Laura, if you got slides up. I think I have one. We can go to our second slide. I couldn't, sorry, right there, yeah. So we are live today, as you can see. I want to start by introducing our panelists. I'm really pleased that we have both Kevin Chan and Sandra Grieve with us today. Kevin is a tax partner at PwC Canada with over 22 years of experience providing Canadian corporate and cross-border tax services, including cross-border financing, corporate reorganizations, corporate compliance and tax audit defense, to large and medium-sized multinational companies across multiple industries, including mining. Kevin also has significant experience on M&A transactions, including tax due diligence, domestic and international structuring, and tax modeling for both Canadian inbound and outbound companies. Sandra Grieve is the head of mining, the mining industry team at Bennett Jones. He practices public market finance and mergers and acquisitions. While Sandra acts for clients in a number of industries, he focuses on global mining exploration, development, and extraction. In the finance field, he acts on behalf of issuers, underwriters, and agents with respect to domestic and international securities issues. His M&A activities include engagements for a variety of vendors and purchasers in the context of the full range.
Hold on 1 second. I just got to mute something here.
Oh. Are we okay?
Yeah, I think you can keep moving forward, Lisa, just on Kevin's end.
Okay. Sanders' M&A activities include engagements for a variety of vendors and purchasers in the context of the full range of friendly and hostile mandates. Sanders is an active contributor in national, provincial, and local politics, providing policy and communications advice to political leaders. So with that, if we can move to the next slide, please, Laura. Thank you. The genesis of today's event was a series of webinars that Pear Tree's been hosting, which focus on the philanthropic community with particular emphasis on changes to alternative minimum tax, or AMT, that have been proposed by the Department of Finance to take effect in 2024. AMT rules are very complex, and we'll hear a little bit more about that shortly, but essentially provide an alternative method of calculating an individual's income tax, which is used if the deductions and credits used in the normal calculation method would result in tax below a minimum amount. The AMT changes are significant for donors and charities because there'll be less favorable tax treatment for donation, both in cash and by way of publicly listed securities. So why is this important to the mining community? Well, if you take a look at the slide that you see up on your screen right now, you'll see that the vast majority of equity raised in on Canadian exchanges for exploration in Canada is raised using flow-through shares. And if we can turn to the next slide, please, Laura. As you can see from this next slide, most of the shares are purchased for donation purposes. Pear Tree is the largest source of equity capital for exploration in Canada, and we know that if AMT changes as proposed, the typical Pear Tree client will need 50% more income to be able to purchase the same amount of flow-through shares in 2024 as they did in 2023. And if this isn't the case, there would be about 1/3 less capital available for flow-through share offerings. We don't think that the government necessarily appreciates the significant concentration in terms of the small number of flow-through share subscribers who are responsible for funding most of the critical mineral exploration that's happening in Canada right now. Laura, actually, if we could go to the next slide, please. And this next slide has some numbers in it, which I've updated generally, and there has been around $500 million of capital raised for critical minerals exploration in Canada since the introduction of the critical minerals exploration tax credit by the federal government only about 18 months ago. Pear Tree's provided about $320 million of that amount. And I can tell you that probably about 80% of critical mineral exploration financing in the country is being driven by a group of not much more than 1,000 people. And those are the same people who will be impacted the most by AMT changes. So there's a concern that the proposed AMT changes could really undermine the government's stated policy of making Canada a leading global supplier of critical minerals for the green energy transition. So with that, I'd like to turn to Kevin as we open things up for our panelists. And Kevin, I don't want to get too technical, but if you could spend a minute explaining a little bit about the impact of AMT on flow-through shares, and I'm thinking particularly about these sort of artificial capital gains inclusion that's built into that structure.
Sure, thanks, Lisa. And so for those who aren't familiar with the alternative minimum tax, or the AMT, the federal budget in 2023, earlier this year, really announced significant changes to that regime. And the government's policy for doing this was, in their view, to better target that AMT to high-income individuals, so to ensure that they pay their fair share. And so in August of earlier this year, the Department of Finance did release draft legislative proposals to modify the AMT. And so and these rules would be effective, or these new rules would be effective starting in the 2024 taxation year. So doesn't impact this current year, but will impact taxpayers in the 24 year. And these are the most extensive reforms to the AMT regime since it was introduced in 1986. So certainly it's caught a lot of the attention of many of the folks in the tax community. Now, I'll be the first to say I'm by no means an AMT expert, but I'll do my best to try and explain some of the general concepts of the regime as best I can, and really the implications to investors in flow-through shares, just so this audience is aware of why the AMT is relevant for issuers. So, as Lisa mentioned, the AMT regime is a very complex calculation, and effectively what it does is it takes a taxpayer's regular taxable income, so your income less your expenses, which would include CE deductions for renounced flow through, as well as once you calculate your tax payable, you can deduct the critical minerals tax credit if it's available, as well as a charitable donation credit. And so what the AMT rules do is they take that I'll call it regular taxable income, and it adjusts it to calculate what's called AMT income. And then when you take that AMT income, which is adjusted for certain rules, you then take off an exemption, you multiply it by the AMT rate, and then you compare the two tax liabilities. And if your AMT liability is higher than your regular tax liability, then you effectively pay AMT equal to the difference between your tax bill that you would otherwise pay under the regular rules and under the AMT rules. And to the extent you pay that AMT can be carried forward, just like other types of tax attributes, and it can be carried forward for up to 7 years. Now, in terms of the current proposed changes, there are a couple that are really impacting investors in flow-through shares. So I'll go through them in a little bit of detail. The first is this artificial capital gains inclusion that Lisa referenced. What it does is, as most on the call would know, in Canada, capital gains are taxed only at 50% in Canada to individual taxpayers. And so when you invest in a flow-through share, the flow-through shares do not have a cost base. And that's because the investor has effectively deducted 100% of that cost using the CEE that's been renounced to them. So when that flow-through share is donated or sold, there's a capital gain equal to the full amount received. Now, under the normal rules, only 50% of that gain is taxable. However, under the proposed AMT changes, in calculating your AMT income, 100% of that gain will be taxable. So that's one of the big adjustments that we're seeing in terms of the impact of AMT on flow-through shares. And the other change that will impact the donation, in particular of flow-through shares, is when an investor donates their flow-through share, they get a charitable donation credit equal to the fair market value of the shares. However, under the AMT rules, that donation credit will only be limited at 50% of the credit otherwise available. So when you take a look at the changes to the inclusion of the capital gain at 100% plus a 50% limitation on the deductibility of the donation tax credit, effectively, as Lisa mentioned, what that means is that taxpayers may require a significantly higher amount of income for the same dollar flow-through share investment in order to avoid paying AMT. And so, as I mentioned earlier, the AMT rules are very complex. But if there's one thing you can take away from this in terms of the AMT, it's really that if the legislation is enacted as proposed, we do expect that this could have an impact on the amount investors are willing to invest in flow-through shares. Now, I know Sandra's probably had some experience talking to clients in this space. I don't know if, Sandra, if you want to share some of the on-the-ground feedback you're hearing with issuers on this topic.
Happy to. Thank you, Kevin. We're seeing it from clients expressing an interest in how to structure their donations, in advance of AMT. I'm also hearing it from people in the charitable sector that I have contacts with that are having, people who are on longer-term donation arrangements who are speeding up those arrangements, or just making plans to complete or donations through the balance of this year in order to be out ahead of the AMT revisions taking effect next year. So we're seeing some of that activity right now, and expect that will amplify through the balance of the year, especially to the extent to which taxpayers don't have clarity on how this is going to impact them, which I think in part is a piece of the problem where as we're wrestling with the impacts, taxpayers themselves are in fear of what this may mean to them. In some cases, justifiably, in others, maybe not, but it's driving action no matter what.
Yeah, I think, Sandra, from our end, we're also seeing kind of an acceleration in demand from philanthropists and wanting to make flow-through share purchases for donation purposes, because they're really uncertain as to what will happen next year. I would say, and I don't know if either of you have any additional insight into this, that these changes have been proposed to take effect in January in 2024. I know we've been prompting people, and I would sort of urge those that are listening today in the mining community to think about reaching out to government, because the policy that they have been promoting, and which they've shown can be very effective through the additional tax measures such as the critical minerals exploration tax credit, has really brought a lot of new investment into the sector, and is I think a great example of how the government has put in place a measure that's moving that policy forward. But the concern is that perhaps this is an unintended consequences, that with regard to flow-through shares in particular, especially with that deemed zero cost base and the large impact that the change in capital gains taxation under AMT will have, that perhaps the government is not as aware of the fact of what the implications could be for the mining industry, and specifically for critical minerals exploration. So I don't know if you've heard any chatter in terms of what the government is hearing or listening to, and any chance of changes over the coming months?
I personally haven't heard, Lisa. I think certainly the charitable sector has made a lot of submissions, I think, around the impact to donations. Certainly, I think there's a valid conversation around the fact that do these AMT changes really go against the government's focus on critical minerals and that 30% tax credit that's available? So certainly, I think as they go through the submissions and the internal consultations, they'll consider that, and we'll see if that gets adjusted, or whether the certain flow through share credits get carved out. But I think certainly it's been made pretty loud and clear to the government in the proposal, in the comment process, that there could have been some unintended consequences with the AMT changes. I don't know, Sandra, if you've heard anything on your end.
Equally, I have not had any sort of direct or indirect feedback that this is on the agenda at Finance. But I guess what I would take note of are the government's announcements through the course of this year in their attempts to accelerate critical minerals investment, that they would be reviewing certainly the process for permitting in Canada, and concerns that the permitting timeline was not in line with that other stated objective of accelerating investment and development of these projects in order to meet our green energy expectations. So I anticipate that it's in the same vein, that it will be before policymakers.
Mm-hmm. Yeah. Actually, I think one of the things that I would anticipate, and Sandra, I mean, you're very involved in financing some flow through and otherwise, but I think given that any particular individual, in general anyway, will be able to do less based on the same level of income, that if the price of the flow through shares went down, that would have their AMT sort of threshold would kick in later in terms of purchasing the same number of flow through shares. So I think what we're anticipating potentially, just market forces, is that the premiums on flow through shares are likely to be pushed down if you can spend less on flow through shares to get the same deductions in the year in which you purchase them.
Yeah, I think it's even more fundamental than that. I think that the impact from investment in the space, we're making progress on critical minerals, right? This tax credit has worked. It has directed more money into critical minerals exploration. But if you look at critical minerals exploration versus our targets for when we're going to stop driving cars with combustible engines that run on combustible fuel, then we're nowhere. We're so far behind the curve on this in terms of the amount of investment and the project acceleration that's required. Robert Friedland has been out with a great chart showing the amount of copper that's needed in order to complete electrification. It's more copper than we have discovered through human history. We have to effectively double the amount of copper that we have mined through our 10,000 years of mining copper. So we've got this. The hurdle is enormous, and anything that gets in the way of that, if you're a green energy enthusiast, is a huge problem.
Right. I know we have a Q&A at the end, but I do see one question, which is a good question, which is, would a solution be to do this through a corporation if available? And of course, the changes we're discussing apply to individuals, and certainly from Pear Tree's perspective, a lot of our donations are made through Canadian-controlled private corporations. So that's a good observation and question. So I think moving on, in the interest of time here, Sandra, maybe I can ask you, there's been a couple of developments on the judicial front. I mean, late breaking news federally. The Supreme Court of Canada ruled just this past Friday on the constitutionality of the Impact Assessment Act. I understand this is a non-binding opinion. It's a reference question, but the court did hold that Ottawa is overstepping its authority to regulate the resource sector. So can you tell us a little bit more about that and how we might expect this is going to affect mining projects in Canada?
Yeah, so the changes to the Impact Assessment Act were a cornerstone of the current government when it came into office. They have been highly controversial in that they proposed a far broader scheme of review by the federal authorities of a variety of projects, using project scale as the way that the federal government would get in, but then effectively giving the federal government a veto over development across the country. The court has come back and said that it's quite clear that what they're attempting to do here is get into the provincial jurisdiction over natural resources, in particular, and that remains a provincial jurisdiction. So that they are correct. It is a reference opinion, so they haven't struck down the law, but they've given a pretty clear indication. Well, they've given a crystal clear indication that they consider it to be unconstitutional. And we expect that Ottawa now will be trying to figure out what the range is of constitutional authority that they have in order to regulate in this area. And it's not none. There are clearly some elements of federal jurisdiction that projects can call into play. But the broad way that it was undertaken was clearly getting engaged in the regulation of local works and natural resources, which is reserved to the provinces.
And do you think, from the point of view of junior companies, which I would think a number of our listeners, watchers here today are probably from the junior sector, do you think that this is going to be helpful, harmful? Are we just too early to tell? Just a lot of uncertainty now, which I guess is never a great thing.
Uncertainty is unhelpful broadly. Okay, so I use that as sort of the baseline for considering what this means to the industry. There are hints in here that could be, quite positive for the industry. Critics of this legislation in the political sphere called this the No More Pipelines Act, which you could also call the No More Large Projects Act, which would impact this sector. There was fear from some industry participants, which may not be unfounded, that this was factoring into international investors' decisions about where they were going to deploy capital, and that they thought it was becoming harder to see visibility as to building projects in Canada. There will almost certainly be some sort of legislative change from Ottawa to try to comply with the Constitution and continue to regulate in this space. But it's going to have to be narrower, and it will hopefully be, as we speak aspirationally from the sector, it will hopefully be set up, if at all, in a manner that is closely circumscribed to the federal areas of responsibility, and leaves the provinces with their paramount or their primary ability to legislate in this area. Thus, pursuing what we're told through the balance of this year is a crisis of trying to get more investment, chasing these projects in great places like Canada, in order to fulfill this need for society to make the green energy revolution. So this is an opportunity to show how we're going to do that beyond the aspirational statements of just we're going to look at permitting as one of the things to see how we do this. Now we can really, take a clean sheet of paper and say we're going to look at permitting, and we're going to look at how we drive foreign investment and set conditions where they understand the process, they understand how you get to the finish line, they understand what the barriers are to getting there from the outset, to try to actually drive that investment into the sector, which is very important for the sector across the sector, but not to overuse a word, but from a critical minerals point of view is absolutely critical.
Yeah, absolutely. Sandra, maybe sticking to this sort of judicial side of things for a minute, moving to the BC Supreme Court, which recently came out with a decision finding that the mineral tenure regime in that province is unconstitutional. I don't think, if I understand correctly, this is affecting existing mineral claims, but the province is being required in that case to overhaul the system for granting mineral claims. So can you help us understand the implications of this decision?
Absolutely. So this is, unfortunately, set us on another course where we have 18 months that the courts have given the government in order to solve the problem. But from a positive point of view, this is an area the government was fully engaged in British Columbia. They have been looking at this through a couple of rounds of consultation now. So this was, did not catch them flat-footed in terms of potential regulatory change. It was a late September decision against the Chief Gold Commissioner of British Columbia. And it ultimately requires that the province amend its mineral claim system to include consultations with Indigenous peoples prior to the granting of mineral claims. So it's an advancing in the process. The claims process used to proceed without any of that. You did see a regime emerging on a private basis of pre-IBAs that were supporting initial work on projects, but this will be making, effectively some form of that into law in terms of a requirement to consult and have a course with your local communities.
Certainly, lots of changes in a short period of time.
Net, I got to hope that it's positive, that we're going to end up with a system that has understandable timelines. We have governments that profess to now be motivated around the space and understanding, finally the equation that, as one company put it to me, how many Teslas do you get without critical minerals? So,
right.
Hopefully that message is spread to the provincial capitals and to the federal government. We're certainly getting indications of that, but it's the early days, and they certainly have a couple of windows now where they're going to have to act, and their actions will be seen by the world and should be expected to drive investor interest.
Okay, thank you for that. So I think I'm going to sort of move things over to Kevin on another front, moving sort of across the country to Quebec. We've also been faced with a different type of changes. In this case, the administration of certain provisions of the Quebec Taxation Act regarding filing requirements when it comes to flow-through share issuances. This may seem pretty, maybe sort of dry administrative stuff, but it does, have an effect that I think is important for any company that issues flow-through shares to understand. So until about a year ago, maybe a little more, Revenue Quebec didn't really enforce, although I think the law hasn't changed, but they weren't enforcing the counterpart filing requirements to the federal requirements when it came to issuing tax slips to subscribers of flow-through shares who were Quebec residents. And they were accepting the T101 slips as evidence that, they had been a subscriber and that an amount had been renounced to them. The practice changed fairly abruptly, although I think Revenue Quebec's been pretty good about letting people sort of catch up and waive penalties and that sort of thing for the most part. But there are, I think, a number of cases where issuers really can unwittingly get caught in a situation where they don't realize that they actually have Quebec subscribers. So, Kevin, maybe if you can explain a little bit more about what's happened, but also I think that situation that people may be, the case where people may be surprised to learn that this would apply to them. And, ultimately, if you don't properly renounce, there's an indemnity in your subscription agreement requiring a payment equal to a foregone tax benefit to a subscriber. And nobody wants to get into that situation. So, while this is somewhat sort of administrative, it's got wider implications.
Yeah, no, thanks, Lisa. So I'll go through that in a little bit more detail. But yeah, no, as Lisa mentioned, Revenue Quebec historically has been quite flexible with respect to the flow through share compliance that's required under the Quebec Act. Quebec is really the main province that requires individuals to file separate tax returns to the extent they have a Quebec filing requirement. And so, issuers that raised flow through share funds on projects outside of Quebec and didn't have any sort of presence in Quebec, typically would not need to or think they need to file flow through share compliance forms with Revenue Quebec, unless, of course, there was a Quebec investor. And so what we found is that over the last year and a half, Revenue Quebec has been more strict in interpreting the Quebec Taxation Act. And so while historically they may have allowed in circumstances that the investor could just use their federal form, as Lisa mentioned, their federal T101A, which is the slip that you get at the end of the year to claim your deduction and claim your credits. They have now actually gone back and said, no, where there's a Quebec filing requirement, they will require that be filed. And a couple of things what that means. That means that to the extent there's a Quebec filing requirement, the issuer, irrespective of whether it's a Quebec corporation, Ontario corporation, BC corporation, will need to file for a Quebec ID number and pay a $200 check to Revenue Quebec for that, for some of the forms that need to be filed. And also the Quebec equivalent of the T101A form. So these are the RL11 slips and a summary have to be filed to Revenue Quebec. And what they basically said, as Lisa said, is that to the extent these forms are not filed, the Quebec investor cannot deduct any of their renounced exploration expenses. And that has a whole host of implications in terms of indemnities and other sorts of things that kick in that Lisa mentioned. So given that they've only started enforcing these requirements, we do know that there are cases where Revenue Quebec has said they will waive or provide one-time relief for late filing penalties, but this is completely at their discretion. And to the extent that they don't apply that discretion, those penalties can be as much as $15,000. So it's quite punitive if this isn't done correctly. Now, you may think it's relatively easy to identify situations where you need to file the Quebec forms. For example, if a subscriber has a Quebec mailing address, it's pretty clear that they will have a Quebec filing requirement. So those are the easy circumstances. But we have seen situations where it's not as readily obvious, and these are the ones that we really want to flag for this audience. So one of the situations where the Quebec filing requirement may not be immediately apparent is where you have subscribers who are members of partnerships that require those individuals to file Quebec income tax returns, even though they reside in another province. So I, for one, am a good example. So while I live in Ontario, I'm a partner of PwC, and since PwC is a partnership that operates across Canada, I have to file a Quebec income tax return every year by April 30th. And I'm sure this probably goes for Sandra as well as any other subscriber of professional partnerships such as law firms, accounting firms. So you can't just rely on a subscriber's address in determining whether they have a provincial filing requirement. Another example that we've come across is where the subscriber is a flow-through limited partnership and where one of those investors in that partnership has a Quebec filing requirement. Again, similar to my first example, while the flow-through partnership itself may have a non-Quebec address, it is important to understand who the investors in that partnership are in order to determine whether Quebec slips will need to be issued. So those are really two circumstances that we've come across in practice where it may not be as obvious that there's a Quebec filing requirement, but in fact there is. And now Revenue Quebec is being very strict in terms of interpreting those rules or applying those rules. Now, I know Lisa and Sandra can probably talk about some of the more practical ways of actually trying to identify these circumstances. But I know one of the things that's changed now is in the subscription agreements, we've seen self-declarations. So, there's a box that says, I as a subscriber have a Quebec filing requirement. And what that does is that allows the issuer to identify the need to file Quebec forms and make sure that, none of these penalties apply. So I don't know if Sandra or Lisa, you guys had anything to add, but it was hopefully a good summary.
Yeah, I mean, we're certainly taking a close look at it in terms of trying to identify when our clients would have a Quebec filing requirement and putting something in subscription agreements like along the lines that you're mentioning. Well, one of the things though that is interesting is that sometimes a subscriber may not even know at the time that they're buying flow through shares that they will have a Quebec filing requirement. Like if later in the year they become a limited partner of some sort of investment partnership where there's some income is Quebec derived, and because generally speaking flow through share offerings are done using the look back rule where the effective date of renunciation of the expenses is December 31st of the year. So if you subscribe for those shares in March, a lot can happen between March and the end of the year. So we're really taking the view with the companies that we work with that unless for some particular reason where we have one subscriber or something where it's like crystal clear that there will absolutely be no Quebec filing requirement, that everyone should just, do both federal and Quebec. They kind of mirror each other. It's not complicated. It doesn't involve, a big expenditure as long as you're not late and get into, late filing penalties. So I think the best thing for everybody is just to file in both jurisdictions. While we're talking about Quebec and Kevin, you mentioned discretion in terms of the penalties. I'm going to sort of put Quebec like in a good light here with respect to another issue that's come up recently, and that's concerning wildfires in Quebec, and well, not just Quebec. I mean, we've seen this in a number of jurisdictions, but as many people will know, if you did a flow through share raise in 2022 under the look back rule, you've got until the end of this year to spend those funds. And we are hearing from a few people that they're concerned that because they were, either completely denied access to their property for a certain period of time, or there were, even situations where government was sort of like commandeering helicopters and things like that to be able to fight the fires, that obviously their planned expenditures were interrupted. And I understand, and Kevin, perhaps you can shed a little more light on this, that under the Quebec Taxation Act, there's some discretion for the government to act in terms of extending timelines, but I don't think that's the case federally. So I'd be interested in hearing about where we think we sit right now for anybody who has concerns about being able to meet their spending deadline when they, were affected by wildfires, which clearly, were well beyond anyone's control.
Yeah, no, so you're right. Under the Quebec rules, there is discretion within the legislation for the minister to allow for the extension of the spend period. Unfortunately, within the Income Tax Act, there isn't such discretion. So I know there have been conversations with folks at the CRA, and they've effectively said their hands are tied in terms of being able to not apply the law as it reads. So I think certainly to the extent taxpayers are in that situation, it would require an amendment to the Income Tax Act to allow for that discretion. Now, we have seen circumstances where finance has done that. COVID is a great example of a situation where the legislation was amended to allow for an extra time period for issuers to spend the required flow through. But unfortunately, at this point, I know some folks have put submissions in. We haven't heard anything in terms of finance acting on that, but I think certainly if you're in that situation, it might be something worth considering raising with the Department of Finance.
And Sandra, any other things you might have heard? Your ears close to the ground. A lot of these issues.
Similarly, got the similar information to what Kevin has, but nothing better, I'm afraid, at this point.
So while we're focusing on Quebec, Sandra, I don't know if you have anything that you can share with us in terms of some changes that I understand are coming to the Quebec Mining Act that are going to require, I think, additional community consultation at like an earlier stage before drilling and anything else that's considered impact exploration can be conducted. Are you I mean, I
Yeah,
think
there-
this is not in effect yet, but anything you can tell us about what's coming?
It's clearly on its way. So amendments to Section 69 of the Mining Act were adopted to create a new authorization process for certain mining activities. It includes diamond drilling amongst them. So it would be key to the exploration part of the universe. It requires an exploration company not to engage in full blown, hiring a third party to run community consultations, but to collect answers, requests, and comments from local municipalities, from First Nations groups, and to collate the answers provided, and then to provide that all to the authorities in terms of requesting the authorization. So it does add another process to this. I guess when you look at it next to, next to what's happening in British Columbia, it may all be part of the same broad movement to ensure that there's some level of consultation at an earlier stage of projects. I think the hope of people around that is that the system is set up that is, comprehensible, that has, deadlines and forms. Then it can add to efficiency. To the extent that it is opaque and involves no deadlines, it of course has the opposite effect. So I think everyone's anxious to see that something come along that gives some of that certainty that the markets crave so much. The expectations would be there's a lot of heightened pressure on governments around the world to provide more certainty, more timelines, and that will be reflected in the final process that comes into force here.
And is that I think is that coming into force next year, or is
I think it's 2024 that the projection is that it'll be in force.
okay? So I think for me, in terms of big questions, the final matter that I want to try to tackle today is with regard to some positive legislative amendments that are making certain expenses with regard to the extraction of lithium from brines eligible for flow-through treatment. And to some extent, that would allow subscribers to also claim the new 30% federal critical minerals exploration tax credit. So, of course, very welcome news. And, since the critical minerals exploration tax credit was introduced for hard rock lithium exploration, we've been involved in, hundreds of millions of dollars of fundraising. So clearly, it's been mentioned already today, very, very effective measure to advance the policy towards making, Canada sort of an independent nation in terms of critical mineral supply. But I think the draft legislation has been released, raises a number of tricky questions. So I'll sort of open up to both of you. The approach that finance has taken has this concept of deeming all wells from which lithium is extracted that's sent to the same processing plant to be a mine, to sort of fit within the sort of existing legislative framework. So I find it a little bit difficult to know when expenses qualify as exploration versus development, because the legislation sort of provides that there could be expenses that are what are called Canadian exploration expenses, which are deductible all in the year in which flow-through shares are purchased, or Canadian development expenses, which are amortized over time and also do not attract the mineral exploration or the critical mineral exploration tax credit. So I'm wondering, there's a couple of different questions there, but with reference to sort of this definition of a mine and how you sort of sort through that to know whether or not expenses are exploration expense or development expense or neither, if you could help us understand the proposed legislation.
Sure, Lisa, I'll take a step. So just to step back a little bit in terms of, I guess, the general rules around CE. So in order for expenses to qualify as CE, they need to be for the purpose of determining existence, location, extent, quality of the mineral resource. That's kind of the fundamental definition. And there's a clear line in terms of when that timeline stops. And that's when the mine has come into commercial production effectively. So any expenses incurred after commercial production do not qualify as CE and would not qualify for the critical minerals exploitation tax credit. So in the draft legislation for the new lithium from brine, what they've done is they've introduced a deeming rule that says to the extent you incur or you extract material from a well that is processed at the same processing facility as another well, those two wells will be deemed to be one mine. So if the other, if the material from the other well has brought the mine into commercial production, you wouldn't be able to incur CEE on that second well because that well is already part of an existing mine that's in commercial production. That just kind of, I tried to set why this is relevant for purposes of this conversation. Now, the government's taken it even further in terms of the draft legislation, because not only is there's this deeming rule that says where you process at the same plant, those wells are deemed to be the same mine. It goes even further to say that even if the material is sent to different processing plants, the CRA can, in consultation with NRCan, still deem those wells to be one mine where they quote unquote constitute one project. And, based on different geological circumstances, et cetera. So, this discretion to allow the CRA to evaluate the mine on other circumstances does bring into the rules some uncertainty, because you could have separate processing facilities and think you're okay in terms of, okay, well, this well is at this processing facility, so that mine is in production, but I've got this other well, it's going to another facility, it's a separate mine. This discretionary rule does create some uncertainty. And so I suspect, as these lithium from brine projects come into development, there could be more need to get some certainty from the CRA. And this can typically be done by way of a ruling. So, anytime a taxpayer requests a ruling from CRA, they typically will consult with NRCan, whether, if it relates to new mine or if it's a new mine type ruling where you're trying to get some comfort that it's not, that the mine hasn't come into production. But, I think it would be very helpful if there's amendments to the draft legislation for there to be more administrative guidance provided to taxpayers. And certainly, without that, I do expect that, in particular for lithium from brine, there may be more of a need to get an advanced ruling, which, sometimes given the circumstances around capital markets and how quickly issuers want to raise, that may or may not be feasible. So, unfortunately, still some uncertainty, but hoping for some more clarity from the government when these rules are enacted.
And Kevin, these days, I think it sort of ebbs and flows, but in terms of an advanced tax ruling of that nature, do you have an idea of what the timeline would look like?
So the last time I checked, I think their CRA's commitment is 90 business days, but that's 90 business days from the date they get all relevant information to do the assessment. So. Not the first time you give them a call and say you want a ruling, but once you've kind of put your full submission in. But that's my understanding of what their taxpayer guidelines are. Certainly, complexity may require it to be shorter or longer, but that's kind of what they've stated as their goal in terms of rulings.
Sandra, are you finding since the draft legislation came out that you're getting outreach, from clients? I mean, you have offices in different parts of the country. I guess a lot of this is Alberta based, but are you getting many questions or seeing much interest in raising funds now to try to get some of these projects off the ground?
Yeah, we are seeing great action around lithium. The hard rock lithium has been a great story this year. And the brine projects clearly seem to be coming on from a level of corporate and investor interest. So, we have been dealing with that. We expect we're going to continue to be. And we're hopeful that people like the people on this call and our associations of MAC and PDAC are pushing to have a system that's got more transparency and clarity around it as these rules get solidified.
There is one small technical point that when we talk about lithium, hard rock lithium, interestingly, before the lithium from brines was added to the flow-through share regime, it was necessary to go to NRCan to have a lithium project certified as something that fit within the definition of a mineral resource. That's being changed for hard rock mining, but they haven't gone backwards. And there are projects where I think people are surprised to learn that they needed this certificate, and it seems pretty silly to me that NRCan or CRA would require certification, for projects where funds were raised in the past year or so. But certainly the draft legislation didn't seem to capture anything before the current timing. So either of you have anything to say about that in terms of what's expected?
Yeah, I mean, we certainly think it's, superfluous in terms of, just requiring that mineral resource certification, when clearly in the 2022 budget, the government was encouraging taxpayers to raise funds and giving the critical minerals tax credit of 30%. And so, we're hoping when the government does finalize the legislation for 2023 that they make that non-requirement, if I can call it that, non-requirement to get a certification retroactive back to the budget 2022 announcement. So far, they've only made it from the 2023 announcement and forwards, but we are hoping that the cooler heads will prevail and they'll understand. And I think certainly in the technical notes, the government's clearly identified that it's an administrative burden that's really not required. So we are hoping that they will make that retroactive back to the 2022 budget. But until we see the final legislation, we'll just have to wait and see.
Okay. Well, I think that probably takes care of the questions that I had. I mean, before we move on to see whether there's any questions to answer, anything, Kevin or Sandra, that you want to add? I mean, there does seem to have been so many recent changes, either legislative or judicial decisions. I want to make sure I've given you the chance to comment on anything important I may have missed.
I think we've hit the big ones. I guess, the one thing I always say whenever I speak to any audience of people who are mining professionals is, one of the things we have to be most concerned about is attracting investment into this jurisdiction, and the certainty that we have the ability to execute promptly on behalf of investors in this space. It has, there's an ebb and a flow to that. I won't pretend there's an arc of history that bends one way or the other, but I think we can impact the arc of history of how that bends through our involvement in MAC, in PDAC, and through reaching out, personally to your member provincial parliament, so they understand the role that mining has in their communities. My strong suspicion is that the member for Eglinton Lawrence, for example, has very little notion of how many people derive their income indirectly, at least in part, from the mining industry in the city of Toronto. They think this is a regional issue. They think this is happening in Sudbury, and they need to understand better that it's happening right next door to them, and it affects the people. It affects, in the crassest of terms, it affects their constituents who vote for them.
Good point. Well, we do have a few questions that have come in, so I will pose the first one. Assuming that foreign individual investors can purchase flow-through shares in Canadian minerals. Oh, well, so let me. So the question is: are there different implications of the new tax rules? So I'll just jump right in here on this one, because foreign investors cannot purchase flow-through shares, I shouldn't say they can't. It doesn't make any sense for them to, because unless they're Canadian taxpayers, they're not eligible to receive the tax deductions and credits associated with flow-through shares. I will say, however, and then Kevin or Sandra, if you want to chime in on this, that as I was trying to illustrate with a couple of slides that I threw up at the beginning of the webinar, the flow through share market has changed tremendously over the past 10, 12 years. And whereas, a dozen years ago or so, there was sort of a small group generally of sort of retail flow through funds that were purchasing the shares that were being offered. And though the investors in those funds were all Canadian retail investors, what's happened is that probably 80% of flow through share financing is being done in the charity format, which is the structured format that Pear Tree arranges, and that results in the shares being donated for charity after they're purchased by Canadian residents, and the charity having an immediate exit to a purchaser that can be a global investor, any type of strategic or institutional investor anywhere in the world. So we have, by sort of separating those two pieces, that the tax benefits of the Canadian investor and the underlying equity for any global investor, opened up flow through shares to an international audience. But it is in an indirect manner. So I don't know, Kevin or Sander, just in terms of the impact of, I suppose, particularly AMT, if there's anything else that you want to add to that.
Yeah, nothing to add, Lisa. I think, you made the point that, typically foreign investors don't get the benefits of the flow through share investment. So, it's not typical that we see that. So I don't see AMT or any of those changes impacting that situation.
Yeah, I think you got it.
I see a question here for Kevin specifically. If you set out a mineral resource estimate, am I correct in assuming continued drilling to expand the mineral resource estimate, or the general exploration area will continue to be CEE?
Yeah, I think with any question around qualification, it very much depends on the facts. So it's very difficult to just kind of say a generic statement that, well, if you've set out a resource estimate, it does or does not qualify. I think fundamentally it comes down to, does it meet the purpose test that the CRA, or that's in the legislation, which is, as I mentioned before, for the purpose of determining existence, location, extent, or quality of the resource. Now, an area that is can be tricky in terms of, that's certainly what CRA's position is, that any amount spent to determine the economic feasibility of a project, even if it's drilling, does not qualify. Now, certainly you can argue whether that's a correct interpretation of the rules or not, but again, I think it's very difficult to just generically say it's this or that. I think it really just depends on the facts and understanding whether that purpose test is met.
Okay, we have a question related to lithium from Brian, which be interested to see if there's an answer, because I think there's probably a lot more questions than answers so far on that front. But the question is that within the guidance provided by the CRA for flow through from mining, metallurgical separation testing to determine recovery rate qualifies for CEE. If a brine well is a mine, then should not pilot testing also qualify?
I think this is, again, we don't really have a lot of guidance from CRA, particularly as it relates to brine. I think some issuers on the call will probably be familiar with the expenditure review table that the CRA's put out, where they go through kind of a whole host of categories and what their view is in terms of, does it qualify as CE, is it CDE, or is it just a deductible expense that doesn't qualify for flow through? Certainly I'd be hoping that the government would consider updating that to reflect the unique circumstances of lithium from brine resource. Having said that, just to clarify, there is a specific carve out from exploration expense for any amounts related to depreciable property. So I know a question someone asked me was, what if we build a pilot testing plant, for example? The cost to actually build the plant is generally considered to be a depreciable property, and that would not qualify. So just, hopefully that helps. But I do expect or hope that the government will come out with more guidance, or at least update that expenditure review table to address some of these questions that are specific to lithium brine.
We have one more question with regard to lithium from Brian, which I think is a more straightforward one, which is, do you choose either CDE, CEE, or CMETC, the critical minerals tax credit, or do they get sort of stacked together?
So I guess they're kind of different things. So it's generally either CDE or CEE. So CE is 100% deduction. The CDE is a 30% declining balance deduction. The CMETC is for the individual investor over and above the CE deduction. So they'll get their 100% deduction plus a 30% tax credit on top of that deduction. So yes, it would be both if it's CE related to a critical mineral flow through. Hope that answers the question.
Right. And I see there was another question really around the CDE, and that's why it's so important to understand sort of what categories the expenditures fit into for lithium from brines, because you cannot get the credit if it's CDE as opposed to CEE. So I think we're through most of the questions. If your question hasn't been answered, we can certainly respond in writing following the session. I did. There was actually one thing I did want to point out, and maybe sort of a final question from me, which is, I think with everything that's been happening, so many new legislative changes and court cases that we've seen in the space lately, one thing that I think people have maybe forgotten about is that the regular mineral exploration tax credit, the 15% credit federally, which is added to any grassroots exploration for any type of mineralization, not just critical minerals, is coming to its the end of the 5-year period for which it was put in place. And I mean, there was a long time during which we would get these 1-year renewals, and everyone would be holding their breath because there was an expiry on March 31st, and seemed to give the government a good opportunity to make a great announcement every year at PDAC. So I'm not sure if that's why they were doing it on an annual basis, but we did have the introduction of a 5-year renewal, which is actually expiring this coming March. So partly a reminder to people that that's obviously something important in light of all this. But Sandra, Kevin, anything that you've heard on that front, or is it just something that people haven't focused on lately?
Yeah, I think everyone's been focused on the critical minerals tax credit, but I'm not going to prognosticate, but I think certainly the history of the government's position, both liberal and conservative governments, has been to continue the credit, given how important the mining sector is, and particularly grassroots exploration in Canada. So I would be surprised, but then again, you never know with government policy.
The same here. I haven't heard anything directly, but I would be shocked, I think, if there was a change to that. There, as you work around the world with various jurisdictions around this, especially in Australia, they view our tax credit regime quite jealously, and wish they could convince their regulators to try to encourage investment in the same way. But it's hopefully our government sees it in the same rosy view.